So, hello guys. Today we are here to talk about the mode 3 of the Goldfinch finance, which is the balance sheet, especially. So we are here in the balance sheet. What's record and asset? In asset means what the company's own, which is the plus, equals to liability and equity. In liability is third party, as in what the company owns, people that render service, and in equity we have is what the company owns on its own. So in asset we have to talk about it. It's divided into two, and we have the current and non-current for the space of 1 year. And we'll talk about the current. And the current will talk about the inventories. Inventories means goods in stock, meaning what the company still has in their stock. And we have the expected cash for goods sold outside. Then we have the cash debt, what the company's own people. Then we have the prepaid expenses, what the company has already been paid for. Then in there we'll talk about the non-cash, non-current. They'll have the long times investments in other people's business. They'll have the non-physical asset, e.g. IP, realities, and have the plants, property, and equipment. So in others, we move to liability, which is already here. And the liability is divided into two. Also, we have the current, and the non-current, which is space of 1 year. In the current, we have to talk about the salaries. We'll talk about the payment of service, goods, service that company has already, and then we have the tax payable, that's the company do not pay, and we have the premiums, and the loans. Then we'll come back to talk about the loan current. We have the personal pension funds, what's maybe like people that work for the company, they decided to retire or something happened to them. After everything, the company need to pay them for pension fund, so that after the company they can see something to fall back to, and have the defaulted tax and the long time loan. So in all, we'll move down to like equity. So we come to here. In equity we have in two places, which is the owner's equity and the profit reinvestment to the company. So in all of this, the balance sheet must be balanced, which is we have the asset equals to liability plus equities. So guys, thank you. So guys, in all we have talked about, we need a brief summary about it for people to understand what we have been talking about. The balance sheet. Balance sheet is what a company owns, asset, and equals to liability and equity. In the equity meanings owns, that's the sign of this plus. In the asset we have the current and the non-current in the time of space of 1 year, and have it in a liabilities. In the liabilities we have non-current and the current, and we'll come back to equities. Then let's go back to the asset. In the asset we have inventories. Inventories is a goods the company have in stock, and we have the expected cash for goods sold. The goods companies are already sold out, they are expecting cash. And also we have the cash debt and the prepaid expenses, meaning what the company has already been paid for, that's the current. Then let's talk about the non-current. Long time investment in other people's business, because you don't just do business on your own, you invest also, so that you have more profit. Then we'll talk about the non-physical assets, e.g. IP, realities, and have the plants, property, equipment also. So let's go back to the liabilities. We'll have the current and the non-current. In this one, let's talk about the non-current first. We'll have the personal funds. The personal fund is what maybe when people are coming to your company to work, if there is no personal pension fund, they will not be working with their heart. But when there is pension fund, when at the end of the day they have something to fall back to in the company, they will work with you and serve you with all their heart. And have the defaulted tax, which is loan and tax the company do not be able to pay for 1 month. They can take it to the other month and clear it, and long times loans. So let's go to the current. We have the, you can see here, we have the salary, payment of service, and tax payable. We still have also the premiums and the loans also. So let's go to the equity. In the equity here, because this is the equity, it's grouped into what the companies, the owners equity, and the profits reinvestment in the company. So guys, in all, we still need to come back and balance the company. Well, as the assets cost to liability plus equities. So guys, thank you.